Well, hello, everyone. Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar that's being brought to us with or by the Singapore Exchange. Now, I'm very pleased to have Tariq Dennison with GFM Asset Management from Hong Kong as our presenter today. So, Tariq, thank you very much for joining us. I'm going to pass you the controls. If you can share your screen, we'll get underway. Thanks so much, Tariq, and welcome.
Thank you, Cynthia. So I've just clicked the Show Main Screen button and hope that works. I'll go ahead and put on the main present slide here. Okay, there we go. Okay, good. So welcome, everyone. I would like to thank you for registering.
Tariq, if I could interrupt for just a moment, in the upper left-hand corner, could you use the slideshow?
Use slideshow.
There you go. There you go. And that should put it into full screen. Perfect.
Is that better?
Okay, excellent. Very much so.
Sorry.
Thank you.
Sorry about that. Well, again, thank you everyone for registering and logging on, and thank you for bearing with the with some of the IT issues, which inevitably you would expect in a webinar, but I look forward to seeing your questions at the end of this presentation from all around the world in what is truly one of my favorite and I often feel underappreciated equity markets of the world. It's a city-state that many people love visiting, but I find not as many actually appreciate the opportunities in its stock market. We've chosen as the title for this presentation, Crazy Rich Stocks. After several presentations I've done with Singapore Exchange, I finally get the chance to talk about Singapore's own home markets, especially the MSCI Singapore Index and some of the stocks listed in there. So let's go ahead and dive right into it. First of all, starting with two disclaimers. First of all, this is our disclaimer from GFM Asset Management. And now here is a disclaimer by Singapore Exchange. Okay, good. So with the disclaimers out of the way, I'd like to go ahead and introduce myself. Some of you may have attended some of my earlier webinars on Taiwan, on mainland China A shares, and on some of the other markets whose futures I've discussed with Singapore Exchange in terms of access products, including India. But as background, my name is Tariq Dennison. I am a Hong Kong-based certified financial planner and wealth manager. My main business is managing investment accounts, especially retirement plans, on the Interactive Brokers platform. I have two entities for doing this, but based on whether my clients are based in Hong Kong or outside of Hong Kong. With Interactive Brokers US, we have an SEC registered investment advisor firm called GFM Asset Management, and here in Hong Kong we have a Type 9 licensed asset management firm, GFM Group Limited. I am a founder and principal of both firms, licensed in both the US and Hong Kong. I myself have been active investing in the market since 1998. My work experience spans the German bank Commerzbank, where I worked in New York, London, and Frankfurt, Bear Stearns in New York, JP Morgan in New York, which, as you know, took over Bear Stearns in 2008. I came out to Hong Kong with the Canadian Imperial Bank of Commerce in 2010 via Toronto and London, and I've also worked with Societe Generale here in Hong Kong as well. I have a master's in financial engineering from the University of California at Berkeley, and I am a visiting professor of fixed income and alternative assets at ESSEC Business School in Singapore, which is one of the reasons that I frequently visit Singapore and get to teach at Singapore and interview CFOs of some of the companies there. I'm especially focused on the US-Asia corridor and many of the tax treaties and trade agreements going on between the US and China, US and Singapore, US and Japan. And most of my clients, therefore, are on one side or other of the Pacific, either Asia residents interested in investing in the US or US residents interested in investing in Asia. As mentioned, I'm an IFPHK, Hong Kong Certified Financial Planner, and my book, if you would like the chance to look it up, is over there on the lower right-hand corner. It's titled Invest Outside the Box. If you Google that, you will find my 11-chapter, 300-page guide to understanding different asset classes and strategies across global markets. I would very much look forward to any feedback if you get the chance to read that book and hopefully learn something that you didn't otherwise know. So enough about me. I need to start every presentation with answering a very, very obvious question. And even on something like Singapore, apologies to those of you based in Singapore, you would not believe how many times I have gone to places like the US and had to answer the question of what is Singapore? Where is Singapore? If you, I'm sure, went to many streets around the world and asked people to point out Singapore on the map, depending on where you went, you may or may not get something within 1,000 miles of the actual Lion City. So as many of you may know, Singapore is a small island of about 700 square kilometers, very close to the equator, right at the Straits of Malacca in Southeast Asia. I pointed it out here on the map. It is wedged right between Malaysia and Indonesia. It actually used to be part of the British colony of Malaya until it gained independence from Malaya / the British Empire predecessor in 1965. So one thing that's very important about Singapore is that it is an independent sovereign nation and has been since 1965. The U.S. Embassy in Singapore, for example, is an embassy. It deals directly with Singapore as an independent sovereign nation. That's quite in contrast to here in Hong Kong, where I'm sitting, where Hong Kong is a special administrative region, a separate territory of the People's Republic of China. Singapore is distinct from any other country in that way. So what makes Singapore so fascinating? Now, this is something that many visitors to Singapore notice when they get on the ground. When I've done some surveys asking what word comes to mind when you think of Singapore, people think the words clean, people think efficient. Some people have even used words like boring. But what fascinates me about Singapore is how far it has come in its short time as an independent country. And what's remarkable here is just the red line in this chart. If you look at the red line in this chart, you'll notice that the GDP per capita of Singapore was slightly below that of the global average back at independence in 1965. And in some of the photos I'm going to show you later, those of you who are over the age of 50 will remember a time that Singapore was a relatively poor country. And from 1965 to 1990, the Prime Minister Lee Kuan Yew had several programs of development that brought Singapore from a third world country to a first world country. And as this chart shows, the per capita GDP of Singapore on a per person basis, Singapore is wealthier now than the United States. It is one of the richest cities on earth. It has surpassed the UK, it has surpassed the United States. And as I've often said to those watching Brexit, Singapore faced its own hard Brexit back in 1965, and look at where it is today. Now, obviously, there's a lot that you cannot compare Singapore with the rest of a larger country like the UK, namely that it is a city-state, namely that it was able to implement lots of reforms and plans that you wouldn't be able to do in a country like the UK. But that by itself, in one chart, is the Singapore story, which is quite remarkable and very hard not to be impressed with. Now, if we look at some photos, one of the things I like looking at is I like looking at some old photos of the history of Singapore about this development that go a little bit deeper than that chart that I just mentioned. The first one is the front page of the Straits Times on the day that Singapore gained independence, or here is actually right afterwards. This is dated August 10th, 1965. The headline is "Singapore is out." And if you look for video clips and so on in this era, you'll notice Lee Kuan Yew was not excited about this. The announcement of independence actually came with tears and fear rather than with excitement at the time. That one was from the Wall Street Journal in 1965. Here's another photo from the early independence days of Singapore. This is Lee Kuan Yew going out to what the streets of Singapore used to look like, with laundry hanging outside. You can see the rickshaws and other things, which, again, you would be hard-pressed to find outside some touristy vestige areas of Singapore. If you look at what Singapore looks like now, this was a photo I took there on Marina Bay 2 months ago. And you can look at several videos on YouTube of what Marina Bay looked like even in the early 1980s. That's the level of development that we're talking about there. Again, with the rule of law, with a level of efficiency, with level of capital freedoms that you don't see in a lot of other countries with the same levels of growth. Now, one other thing that I mentioned recently on Twitter and has surprised a lot of people when I mention it, especially around the topic of Brexit, is what has happened to the Singapore dollar as a currency since independence in 1965. Now this chart, I believe, says 1,000 words, just as much as the earlier chart on GDP per capita. This shows the exchange rate of the Singapore dollar versus the US dollar compared with the British pound versus the US dollar over the past 54 years, from 1965 independence to 2019. This data is from the Bank of International Settlements, and roughly in that time, the Singapore dollar has more than doubled in value against the US dollar, while the British pound has lost about half of its value versus the US dollar. In other words, in British pound terms, the Singapore dollar has quadrupled in value since Singapore's independence from the British Empire. Now, you can put whatever you want to, whatever explanation and so on there, but that is what it says in the currency exchange rate in its own right. There's something worth saying about the Singapore currency and how I often describe it in a category of currency appreciators. If you followed my earlier presentations on currencies, you'll know that I've talked about the Singapore dollar in the same category as the Japanese yen and the Swiss franc, where in my lifetime, they have largely appreciated over long periods of time. And the reason is just how their populations approach savings and how their central banks manage their currency and manage monetary policy. The Singapore dollar is managed to minimize its trading fluctuations versus major trading partners. If you look at how the Singapore dollar fluctuates against the US dollar, against the euro, or against the yen, you'll notice it moves less against any of those other major currencies, and those other major currencies move against each other. That's done deliberately because Singapore is dependent very heavily on trade. Now, also as Singapore has developed, the MAS, the Monetary Authority of Singapore, has managed its currency, has used its currency as a tool for managing the economy. When you hear about the Federal Reserve in the US tightening monetary policy, it does it by raising interest rates. On the other hand, the Monetary Authority of Singapore tends to tighten its monetary policy by letting the Singapore dollar strengthen and loosens monetary policy by letting the Singapore dollar weaken. It's just simply another monetary policy tool that can manage. But as you can see, the Singapore economy has been doing quite well. And so in my lifetime, the Singapore dollar has been allowed to strengthen, again, alongside the Japanese yen and Swiss franc. This is, of course, in stark contrast with, say, the renminbi, the Indian rupee, and other currencies, which have lost large percentage of their values in my lifetime. Now, the title of today's presentation is not Crazy Rich Currencies or Crazy Rich Economies, but it's Crazy Rich Stocks. So getting further into our topic, I feel it important to actually compare the performance of Singapore stocks with other major stock markets that we could be looking at. And here, I want to compare the MSCI benchmark indices of Singapore, Hong Kong, and the UK against the benchmark of the United States, which instead of the MSCI US, in this case, I am using the S&P 500. This data goes back to the turn of the millennium, till right around 2000, 2001, and the reason is this was as far back as I could get total return data from BlackRock on the MSCI indices. And going back to the turn of the millennium, Singapore has been, by a healthy margin, the best performing index on an absolute basis. Now, not necessarily on a risk-adjusted basis. You'll know that Singapore has been more volatile than the S&P 500, but it has outperformed the S&P 500 in absolute terms. On this chart, Hong Kong has been number 2. Hong Kong has done relatively well, very much on the back of a rising China, which Singapore participates in a little less directly. Singapore is more closely related to India, as I've mentioned in other presentations. And then third place on this chart is the S&P 500. The major driver of the returns of the S&P 500 since 2012-2013, when the S&P 500 was actually the laggard, has, of course, been the rise of big technology companies like Google, Apple, and Amazon. Those have been responsible for a large percentage of the outperformance of the S&P just in the past few years. But the recent story you may be familiar with of U.S. stocks doing better than most other foreign markets is a very, very recent phenomenon. And if you look back 20 years, Singapore has performed better than Hong Kong, has performed better than the US. Now, since I'm talking about a former British colony, I always wanted to, of course, compare with the UK itself, and it probably will not surprise most people on this call that the UK has been an underperformer since the Euro crisis back in 2012, 2013, and Brexit since 2016 hasn't necessarily helped either. Also notice all of these returns are in US dollar terms, so they include currency fluctuations or currency appreciation, depreciation in the meantime as well. So Besides the first two reasons of the amazing Singapore story and development of its economy, the absolute performance of the Singapore stock market itself is also something not to be overlooked. So, I mentioned a little bit about the MSCI Singapore Index, which is the main topic of today's presentation. We should now look into the index and see what actually is in the Singapore stock market. What is in the index? Now, the MSCI Singapore, just like many other MSCI indices around the world, MSCI India, MSCI US, MSCI World, is a market cap weighted index. That means that larger companies are going to have a larger percentage of the index allocated to them than smaller companies. Simply put, if you have a $10 billion company and a $1 billion company, and you're investing $11, it's going to allocate $10 to the $10 billion company and $1 to the $1 billion company. That's how a cap-weighted index works. Many of these cap-weighted indices are also what's called float-adjusted. So companies that have more free float, more shares actually available to the public to buy, will have a higher weight than closely held companies where, say, the government or an inside shareholder holds a lot of shares and not as many shares are freely floating. But one thing that you should notice when you first look at the Singapore stock market is the top three components. Roughly 50% of the index is in three large banks. The next book that I'm going to be mentioning calls this the Singapore Banking Troika. These are DBS Bank, OCBC, and UOB. If you have been to Marina Bay or if you have been to Singapore's financial sector, this probably will not surprise you. These are three large banks with three large towers. And if you have a bank account in Singapore, there's a very good chance it's with one of these three. Part of this also is because Singapore is a relative financial haven and legal haven. So a lot of DBS, OCBC's, and the UOB's banking business has to do with lending and investing in the ASEAN region, within Southeast Asia. So if you want exposure to growth in Malaysia and to Indonesia, buying shares of a Singapore-based bank is a relatively safe way of doing it because you get the protections of Singapore's world-class legal system and you get their top-trained risk managers sitting in Singapore managing risk for Malaysian loans and Indonesian loans and so forth. So it's not surprising, given that you have a small city-state heavily based on trade and international commerce, that banks make up a very large portion of the index. The next component is Singtel, Singapore Telecommunications, also known as Singtel. If you've landed in Singapore and picked up a SIM card in order to make local phone calls, chances are you would have picked up a red Singtel card. You might have also picked up a green StarHub card or a yellow M1. Those are its major competitors. But that's the main telecommunications company there. Again, probably not too surprised. As you then step down, you'll notice Keppel is the next one having to do with shipping. Probably not a surprise for one of the busiest shipping ports in the world. And then you start getting into real estate companies. Capital Land, Ascendus Real Estate Investment Trust. One thing that may surprise a lot of investors who are especially interested in real estate is Singapore has 4 times as many listed real estate investment trusts on the Singapore Exchange as does the Hong Kong Exchange. Given how much Asians love investing in real estate, I know there's a bit of a stereotype there. I'm a little bit surprised that I have not seen more interest specifically on real estate investment trusts. But if you are interested in real estate, I highly recommend looking at the real estate investment trust listed within this index and more generally on the Singapore Exchange. If you have time, you can go into a little bit more detail on each of the other names, but I'm going to be presenting a book later that's going to talk a little bit more about the history of some of these names and what makes them up. So we showed in the earlier pie chart roughly what the breakup of the sector was. We showed that it's largely financials. The largest sector in the MSCI Singapore Index is financials. We also have communication services, largely represented by Singtel. And we have relatively small allocations to consumer companies, consumer discretionary, and so forth. And for a long time, there's actually no IT representation at all, quite in contrast to the US index. So in other words, you might say that it's relatively lopsided. It looks a little bit more like an emerging market with index, which is very heavily weighted towards banks. But unlike many what you might call emerging market indices, or even an index like, say, Canada or Australia, you don't have as much exposure to sectors like mining. So the Singapore stock market is still very much based around the industries having to do with international trade, international finance, shipping, and the industries that remain in the city-state or listed in the city-state. And what this chart is meant to show is that those sector weightings have remained relatively stable over time, with financials comprising a big, healthy portion of it. So I mentioned earlier a book that I would recommend as a good complement to my own book. It's actually the same size on the bookshelf. This was written by a friend of mine named Umesh Desai, who's based here in Hong Kong, and his colleague Nandini. The book is called The Singapore Blue Chips. It's a relatively easy read, and it basically goes through the history of 30 Singapore-listed blue chip companies. The reason I recommend this is that Nandini and Umesh specifically go through the history of some of these companies. So, for example, they will explain the background of Keppel, how it was founded, bits about its business, and about how it works. As a shortcut, or perhaps as an introduction to reading the annual reports of each of these individual companies, I highly recommend this book as kind of an easy history lesson in the background of some of these companies, where OCBC came from, where Comfortdelgro Grow is positioned in the age of Uber, and so forth. One of the things I like about this one is the reference to 3 specific acronyms in the introduction, which I found quite funny and definitely worth mentioning here, saying that when Umesh was about to start writing the book, he was asked why he would want to write about Singapore blue chips, because aren't Singapore stocks simply one of these 3 categories: MNCs, GLCs, and PLCs? And not to spoil anything in the book, but these mean multinational corporations, government-linked companies, and poor local companies. That's what these 3 acronyms were referred to in the beginning of the book. But as you can see, if you go into it or start looking into the Singapore stock market itself, these acronyms, just like the word boring, are all kind of tongue-in-cheek. Really, there are lots of fascinating stories and fascinating businesses you find if you want to look into the individual stories of individual Singapore-listed companies. So one of the other things that I would like to thank the Singapore Exchange for is that they have done a pretty nice update to their website. So for example, if you go to the components of the index, or you want to find out more about a company, if you go to sgx.com, you can go to their updated stock screener, where you can, for example, sort all of the stocks listed on the Singapore Exchange. You can sort by market cap, you can sort by price-earnings ratio, dividend yield, and then when you click through, you'll notice that I've given a little insert here of some of the information you can find when you click into a particular stock on the stock screener. So here, one example that I wanted to point out was in the case of Singtel. Why is it that Singapore Telecommunications has a much lower weight than DBS Group, despite the fact that Singtel's market cap is about 80% or 70 or 80% of DBS's market cap? And if you click in and then you go to the tab that says ownership, you can see right there in just a few clicks who are the major shareholders of Singtel. And there you go, 52% of Singtel shares are held by Temasek, are held by Singapore's sovereign wealth fund. Another 5% is held by the Central Provident Fund Board, the major defined contribution pension fund manager in Singapore. So it's probably of no surprise once you look a few steps in. Singtel is what you call a low float company. It's largely held by major government-linked shareholders. You as a minor shareholder can go own a piece of the action, but you don't have to worry about an activist investor coming in and taking it over. You can see that as a plus or a minus if you like, but this is information that you can get once you click into the SGX stock screener. And this is how I often do some of my initial research before I click through and look at the annual reports, which I should also mention a big advantage of the Singapore market is the annual reports are all in English as well. So we also wanted to look a little bit about how is the Singapore market valued relative to other markets. So I was mentioning the performance of MSCI Singapore versus the S&P 500. One reason I am especially keen on overweighting Singapore, underweighting the US, is simply has to do with valuation. I am asked all the time these days, oh, don't you think the markets are too high right now, or is it too late to buy, or don't you think the markets are going to crash or correct? I often point out there are 2 ways that stocks lose money. One is that you buy the stock of a company which actually starts doing badly. The company starts losing money. The company starts losing assets, losing customers. That is what you would call a permanent loss of capital. And generally, you do not want to buy companies whose business is getting worse, whose business is getting a lot worse. You would have wanted to avoid buying RIM, the maker of BlackBerry, when the iPhone came out and you started seeing BlackBerry sales plummet. I do not believe that most Singapore companies are on the decline. Rather, I think Singapore is going to continue to enjoy a relatively healthy rate of growth. It's not necessarily a gangbusters rate of growth, but a healthy rate of growth. And the second factor on whether you make or lose money investing in Singapore stocks is the change in valuation. So it's one thing for a company to keep earning $1 a share every year, or go from earning $1 a share to $1.10 to $1.20. It's another thing of how much is somebody willing to pay you for a share of a company that earns $1 a share. In the US right now, the S&P 500 is trading at over 20 times earnings. That means to buy a US company that earns $1 a share, you're going to have to pay over $20 a share on average. For the case of Amazon, you're going to have to pay over $200 a share. In the case of Singapore, Singapore shares, as you can see in the green line, are currently trading at only 12 times earnings. That means for every dollar a Singapore company earns, you will only have to pay $12 to buy that stream of future earnings. If you were to flip that upside down, you can think of that in terms of an earnings yield, meaning for every dollar you invest in a US company, you're earning less than a 5% yield in terms of earnings from the companies, from your US shares in the S&P 500. Whereas every dollar you invest in Singapore shares, you're earning an earnings yield of around 8%. So just looking at it in terms of yield and valuation, this is where I believe overweighting Singapore and underweighting the US is relatively attractive. The other line that I've included here is the price to book ratio, which I believe is more relevant when looking at Singapore shares than the US shares on average, because as mentioned, a large percentage of the MSCI Singapore Index is in banks and property companies. Those two sectors are very, very asset heavy. And in those cases, what you want to do is you want to buy $100 worth of assets at $100 or preferably $80, but preferably no more than $120. In the case of the US, the price to book ratio of the S&P 500 is over 2, which is not surprising given that the US has more technology and pharmaceuticals and less asset heavy industries. So this is food for thought on those two specific ratios. Again, you can look at them on an individual company basis as well as on an index basis. The reason I included this chart is to show that historically, Singapore shares are not expensive relative to their historic averages. So one other ratio that I look at for valuation, which I know is not the best valuation ratio, is dividend yield. The reason I think it's attractive to look at dividend yield is because that's the actual cash you get in your account either month in, month out, or every 6 months when you buy and hold, let's say $100 of MSCI Singapore. Now, I wanted to rank all of the individual MSCI countries that I had access to, and I ranked them from highest to lowest yielding. Now, right now, the highest yields you're going to get out of any single country MSCI index is in Australia, China small cap, Nigeria, UAE, and Pakistan. Those 5 countries have dividend yields of over 5%. But if you go down this list to countries that you might feel are relatively safe, you will notice Singapore has a dividend yield between that of Malaysia and Italy, which I'm guessing most attendees on this call will say have higher levels of political and idiosyncratic risk right now than Singapore, which is a AAA rated country. You'll also notice in terms of PE ratio, Singapore is right in the middle. So you want to compare PE ratio versus dividend yield to make sure that you're not being paid an unsustainable dividend, that the companies are earning $1 a share in dividends and paying you 50 cents a share in dividends, if that makes sense. The last column I also wanted to show was the sales growth. Now, the reason I'm looking at sales growth, not earnings growth, is sales growth gives you a top line measure of how much the shares in that economy are growing sales. In other words, are customers of listed companies in that country buying more or buying less of those companies' products? In the case of Singapore, customers of Singapore listed shares are buying more, not buying less, compared with, say, Italy, Portugal, or UAE, where they are experiencing year-on-year declines in top-line revenues. You'll notice, of course, that much higher sales growth rates are available in more frontier markets like Nigeria, Pakistan, and Russia, but we can talk about those in another presentation. I would also like to point to, if you're interested, I do have an experimental website with the address of oneworth.net, which you can go ahead and look at and register for a free account. I do have big warnings on there that it is still somewhat buggy and the data on there is not perfect and not updated. But the reason that I developed this site and the reason I launched it is that it's one way to look at scatter plots of information on listed companies. So for example, if you go to the menu on the left at oneworth.net and you click Buy Exchange and you click SGX, you will get a scatter plot of SGX listed companies where the size of the bubble tells you the size of the company. So the biggest bubbles here are the largest SGX listed companies. And then you can do an XY plot of, let's say, the price to earnings ratio and the return on equity rate. So here, the companies that are higher in this chart are more expensive relative to their earnings. The ones that are lower on the chart are cheaper relative to the earnings or higher yielding. And then the left and right axis shows you which companies are more profitable and less profitable relative to their book value. So what I've highlighted over here is DBS Group, that big green bubble in the middle, shows you that it has an 11.6% return on equity rate and about a PE of 11 as well. So it provides you a fairly high yield and a fairly high return on equity rate as well for a bank. But if you have any questions about using oneworth.net, I would look forward to hearing from you, and I'm happy to walk you through any bugs you might find on it. So since we're here talking specifically about how to trade, let's start getting into how exactly do we access the Singapore market. So hopefully I've gotten you interested in at least looking at it, understanding different shares. So next question is, should you just go and buy some individual stocks? Should you buy an ETF? Or should you trade the Singapore market using listed futures? I would like to thank our sponsor, Singapore Exchange, who has provided some data and pointed us to the MSCI Singapore Free Index Futures, which are listed in Singapore, and have been one of the ways that I have traded the Singapore index and hedged Singapore structured products since the early 2000s. The MSCI Singapore futures are denominated in Singapore dollars, and they are probably the most liquid way of trading tens of millions of dollars or more of Singapore index exposure in a short amount of time, if that's what you so desire. Now, do know that these are futures contracts. So you need to post margin. You need to make sure you have margin limits. You need to make sure your account is futures eligible. A single contract has a lot size of about 35,000. So if that's the size you want to trade in, if you want to trade 3 million, you buy 100 contracts. And these are cash settled futures contracts, very much like the S&P 500 or the Euro Stoxx futures contracts. Some of the main advantages of trading via the futures are, first of all, they are very, very liquid. The other is that if you wanted to sell short, you don't have to worry about borrow. You just click sell and you suddenly have a short position with whatever margin that you have there. You don't have to worry about stock loan and other issues. The other also is that they are very, very tax efficient. You are simply cash settling the value of an index on a future date. You are not actually receiving any dividend payments, which might be subject to withholding or so on like that. Your counterparty hedging the futures contract is responsible for that and passes you the net return. So the margin requirements for the $35,000 futures contracts are a little over $1,000. I don't worry too much about margin. You're welcome to ask Interactive Brokers or Singapore Exchange if you have questions about margin. Generally, the way I use futures contracts is I keep margin of about 50 to 100% and really use it more than anything as an access product. They also wanted to show you here that because it is an index future, it has a 97.5% correlation to the underlying index future. Now, the contrast we want to show here is we're talking about the MSCI Singapore Index. Many of you on this call may have been looking at the MSCI Singapore ETF listed in the US. That is ticker EWS. It has $543 million in net assets under management. So it's not quite as liquid or as large as the MSCI Singapore futures contracts, but it is very popular as a way for somebody who just wants to buy and hold long-term Singapore exposure. Because these US-listed ETFs, like many US-listed ETFs, are really meant for Americans, or secondarily for individuals based in countries with good tax treaties with the US. if you are based in Singapore, if you are based in Hong Kong, which does not have a tax treaty with the US, if you buy the MSCI Singapore, if you buy EWS listed in the US, those dividends will often be subject to a 30% withholding tax from the US to your country. If you are talking about a 4% dividend yield and you are here in Hong Kong, 30% of 4% is an extra 120 basis points. That is a very high level of withholding. That is a very expensive way of having your dividend eaten out if you are holding via the US shares. There is also a locally listed ETF in Singapore, ticker is ES3, which tracks the better followed Straits Times Index. And one thing I didn't get to comment on is MSCI Singapore and the Straits Times Index are very, very similar. But really, if you're looking for liquidity and you're looking for what global, world-class pension fund managers and institutional investors use, the index is MSCI Singapore, and these are the two main ways that you've traded it based on what type of account you have, your tax situation, and whether you want to go long or short. So we are also here with Interactive Brokers, and I wanted to show some sample screenshots of what one of these trades look like if you wanted to buy these shares on Interactive Brokers. So here I have a sample screenshot from one of the accounts that I manage, where I buy 1,000 shares of EWS in US dollars on the Interactive Brokers platform. And this shouldn't surprise anyone here. You look on the screen, you see a bid and an ask. The reason that the bid and the ask are so wide is that I did this during Hong Kong hours. I did this when the US market was closed. I basically was placing an overnight limit order, and you can see my limit price was below the current bid and below the last close. I'm not really in a hurry to buy these in this particular account. I'm basically putting this order here so that if the index falls by another 5%, I'll pick up another 1,000 shares. But if you want to look at margin impact, and if you want to look at roughly what the lot sizes and commission rates you're talking about, this shows you roughly how much it will cost to buy 1,000 shares of EWS on the Interactive Brokers platform. Now, by comparison, here's what a trade looks like of selling one contract of the MSCI Singapore futures contract, the STIMSCI, as I probably should have mentioned it. A few things to note here is one contract is about the value of about 1,500 or so shares of EWS in terms of lot size. But you will notice that the commission is lower, which is not surprising. Trading a futures contract usually costs less than trading the same value of stocks, which is why it tends to be a little bit more valuable for traders. You will also notice that the margin requirements for the futures contract is a lot lower than they are for individuals. And I don't have to worry in this case about borrow. I am selling short because this is part of the strategy for buying individual Singapore stocks and selling short the futures, as I will describe in more detail later. So you'll get notice here, the price that you see on screen, whether it's 388, 361, the multiplier for this contract is 100. So the notional value in Singapore dollars is 100 Singapore dollars times the number of points on screen for this contract. So let's talk about some trade ideas. The trade idea that I first mentioned, which tends to be the same pattern of trade idea that I tend to look at for many of these other futures markets, is I would like to go into some of the stocks that I mentioned earlier and build my own portfolio of Singapore listed shares. Maybe I do not believe in having such a high weighting to banks or to property. Maybe I found a few specific healthcare companies, many of which are listed in the Singapore Exchange. I want to buy that portfolio of healthcare companies, but I want to hedge out my exposure to the overall Singapore market going up and down. So the strategy, quite simply, is that I take a long position in an individually selected portfolio of Singapore listed stocks, and I hedge by selling short the MSCI Singapore, aka STIMSCI, aka SSG futures contracts. The drivers for this trade is relative value. I'm basically expecting that the smaller cap or non-bank individual companies that I select as a portfolio are going to perform better than the overall index versus the very bank-heavy index and other components of the large cap index. And on the short side, what the futures contract provides me in this case is a beta hedge of the overall Singapore market. So if you can familiar with the terms alpha and beta, what I'm trying to do is I'm trying to isolate the alpha of my trade and I'm trying to hedge out all of the beta risk. Now, what's the risk of doing this kind of long-short trade? Basically, if I'm doing a cap-weighted index, unless I'm doing even more concentrated in large caps, I have the risk that the stocks that I buy might underperform the index. Of course, if they do, then I'm not going to make as much money on the short position of my futures, or I could even lose money there, and I could lose money on my longs. That's the worst of both worlds for any long-short equity manager, and it's just as true here when you're doing it with futures. The flip side of the outperformance, or one part of the outperformance, is that if I have any single stock risk on the long side of my portfolio, if you've been following, there is a story going around, which I will not mention the name of, but it was on Bloomberg today, of a Singapore-listed company which recently has been running into severe financial problems. So if you had bought shares of that company, you would obviously not be doing well being long that versus the index in that case. But that's where you're going to be facing single stock risk whenever you pick single stocks and bet against the index. The other thing to worry about is dividend carry. So as mentioned, the MSCI Singapore Index does have a relatively high dividend yield of around 4%. If you sell short the index, you will see that every time you roll the futures contracts into the following months. In other words, once the June contract comes due and you have to get out of June and go into September, you will notice the September futures are cheaper than the June futures. That's not because anyone thinks that the index is going to go down, but it's purely because the dividend yield of the MSCI Singapore Index is higher than Singapore dollar interest rates. So in other words, if you hold the futures contract, you're going to expect to earn the dividend yield on the index. If you are shorting the index, you are naturally going to have to pay out that dividend yield to whoever's buying the index futures from you. Strategy number 2. Let's say, for example, you don't want to pick individual stocks in Singapore. Instead, you are, let's say, a foreign investor. You don't want to have to deal with tax withholding or rolling or dividend taxes or so on like that. You simply want to buy and roll a long-term position, a long-term allocation in the Singapore market. And maybe you find futures are a more efficient way of doing that for liquidity reasons or for collateral reasons than using an ETF. So what are some of the drivers here? As mentioned in the earlier one, when it comes time to sell June and buy September, based on the current dividend yield and current interest rates, the September futures contracts are going to be cheaper because of that dividend yield. So you are going to earn the dividend through that roll, through that difference between 1 month futures contract and the next futures contract. You're going to earn it without actually any cash flow of dividends coming to you, and so without any explicit withholding tax. You can compare this in many ways to the accumulating shares of many ETFs that you might see in non-US markets. So if you're listening from the US, don't worry about this. In London and other markets, you have accumulating shares of ETFs where instead of paying out dividends, they simply take the dividends and reinvest it and buy more and more of the index inside the fund. That's effectively what you get to do if you buy and roll the futures contract. Now, the disadvantage of this strategy is that you must roll these futures quarterly. If you just are looking to have a long-term passive exposure to Singapore, this is not the same as just buying the index and waiting. Every quarter you have to roll and maintain your position. But one advantage of this is that if you are mostly, I say, a US dollar or euro or yen-based investor, you don't have to convert your whole allocation into Singapore dollars. You are basically getting exposure to the Singapore dollar index by only putting a small margin in Singapore dollars and keeping the rest of your collateral in whatever your base currency is. We've discussed this most extensively when talking about Japan, but this is true in reverse if you are a yen or a dollar-based investor using the futures to access the Singapore market. Well, this concludes the presentation, the lecture part of the presentation so far. I hope at least it was useful and that for most of you, you learned at least something new about the Singapore stock market, the MSCI Singapore Index, and more specifically about how to trade it, either using futures or using the ETF. I would now like to open the floor to questions, and I will go down first to any questions that I see on the question chat here. So, okay. So I got first one here, question 1. Okay, question 1. Given the ongoing trade negotiation between the U.S. and China, coupled with the evident global slowdown in the past quarter, how would you think the Singapore economy would perform in such an environment over the next 1 to 3 year time horizon? Now, I want to be very careful about how I pull apart this question. There's a difference between the Singapore economy and the Singapore market, and that's generally true about any stock market that you might look at. I'm very often asked, do I believe a recession is coming? The main indicator of is the economy going to be doing poorly is to watch the bond market and to watch interest rates. Overall, when I look at Singapore government securities, when I look at bond markets, I see there being a probability of a U.S. recession and in turn probability of a recession in a few other markets that depend on the U.S. One area that I believe that Singapore is fairly well positioned is that Singapore is not China, and Singapore has a very good free trade agreement with the U.S. Much of the trade still within Asia still has to go through the Straits of Malacca, and I believe Singapore is very well positioned for that and is very well positioned as a legal haven and a tax haven for many of the countries in the region. So given that, I believe the Singapore economy is fairly robust and may be exposed to a somewhat mild recession if you see, let's say, a major U.S. recession or a major trade war, but I do not see that as a major risk. And more importantly, I think as an investor in Singapore shares, Singapore stocks at a PE of 12 are already to some extent priced for a recession. So even if a recession happens, I believe that the shares are priced so that you would still get a moderately good return. And I believe that if you don't see a recession, or if the recession is milder than expected, I believe what that means is you'll see a higher than expected return, possibly averaging 6 to 8% per year over the next decade. Now, I know you asked me over the next 1 to 3 year time horizon. I really cannot predict the future any better than you can, but hopefully everything that I said gives you some idea of what the markets are telling you about the likelihood of a recession and how well Singapore is placed to it. So next question, in a long-short setup, if we were to long the Singapore equity market via an ETF or futures, what would be the counterpart within ASEAN or Asia for the short side? So a time horizon of 1 to 3 years. So I believe this is asking you about a long-short trade between Singapore and some other ASEAN counterpart, again with a 1 to 3 year time horizon. Here, I'm not entirely sure I understand the question, but there are a lot of different markets you could potentially short against Singapore, depending on what kind of pair trade you're trying to do. There are several other regional futures contracts listed on the Singapore exchange, and as well as a few other exchanges, including MSCI Malaysia, MSCI Philippines, Thailand, and so forth like that, if you wanted to take a regional long-short pair trade against any one of those. The far larger and more liquid markets would be China or India, if you had a view that one of those was going to play against the other. I believed that if you were to go long Singapore, short China, for example, you are taking a fairly specific view on both how the U.S.-China trade war is going to turn out, how the China stimulus and China response to it is going to turn out, and how the Chinese financial sector is going to work out, all of which I believe are much more absolute bets on China than I do or any actual relative views of, let's say, Singapore versus China. If, on the other hand, you wanted to do, say, Singapore versus Malaysia or Singapore versus Thailand, those, I believe, are far more like-for-like pair trades, and those would go a lot more into what do you believe are the relative fundamentals of the other ASEAN market. I'm not sure if that fully answered your question, but if you'd like me to go through any of those one by one, you have my contact info here, and I look forward to discussing your question in more detail. So next question. What is the nickname for the index futures? And I think it was misspelled here. I mentioned very quickly the nickname was SIMSCI, so SIMSCI. Basically, it was a short way of pronouncing Singapore, SIMSCI, so SIMSCI. We've mentioned it a few times in our conversation here, and I probably said it a little too quickly. So sorry if that was confusing to anyone. SIMSCI for SIMSCI, if you like. Okay, next question. Looks like the PE expansion has not happened much over the time for Singapore compared to other markets, especially 2011 onwards. Any comments? Yeah, that's on this and for Singapore. We have many same thing true with PD and is the factor out. Relatively will years one company and that company here that only reach out who probably will need these more activity with lots of Facebook and Amazon and so forth. It's not having as you notice the top of the for banks. And that's a relatively amount of years done many people are relatively poor. They're people companies maybe pay 1.2 times the book for and buy at 10, 15 times for you're good people just yield them. That's how they relatively low, relatively attractive. People are not like you get things to know as the rest of the world from the technology sector, in some cases from the health sector. That's part of the answering the question. Thank you. Next question. Can I do short asset account in ADAR? I will say that I have done cash accounts with IRA